This is King World News. I'm Eric King, and you're about to hear a powerful interview with David Tice, Chief Portfolio Strategist of the Federated Prudent Bear Fund. Remember to go to our homepage at www.kingworldnews.com for more interviews, where this week we also have legendary James Dines of the Dines Letter, Bill Lagner, co-founder of Barrons Asset Management, whose fund returned over 100% in 2008, as well as Tom Dorsey, whose work is seen on so many firms' desks each day in Wall Street. Joining us now is David Tice from the Federated Prudent Bear Fund. Let's start off, David, talking about valuations. What is the fair value of the S&P in your opinion?
Eric, we believe fair value is far below where it is today, and a question that I'd like to pose is how far do we decline? We know that the market will decline to below fair value. If you look at EPS for the S&P for '08, it was in the $43 range before charge-offs, et cetera. You look at earnings estimates for '09 and '10 from Strategist, and it's in the $40, $45 range on the S&P. We know that this market's going to decline to between 6 and 10 times trailing earnings. So you look at 10 times trailing earnings for '10 even from Strategist of $45 a share. That's $450 on the S&P. We believe we're going to get to below 400 on the S&P. You look at typically markets at the end of secular bull markets, at the end of credit cycles like this, markets fall to below book value. Book value on the Dow is 3,150. We believe that we're going to get back to the 4,000 range in the Dow. Now, I've gone between S&P and Dow Jones average, but you can see we're a long way down from 1,000 on the S&P. We believe that this market will decline another 60% or so because we have such extreme problems. We've never seen anything like this. The currency is under great duress going forward. Foreigners are going to back away from our holding the U.S. dollars. We're in deep trouble.
And also, David, as you go through these cycles, things tend to go from overvalued to extremely undervalued, do they not?
Exactly, and that's why markets overshoot, and therefore this decline is going to be significant. As the country moves away from pro-capitalist principles, then it's going to magnify that overshoot principle.
What about the change in sentiment? Has the extreme bearish sentiment seen at the recent lows been replaced by bullish optimism at this point, would you say?
Bill Lagner and Kevin Duffy from Barrons Asset Management have done a lot of work on sentiment, and I know you're going to interview Bill in not too long. And they've done a lot of work about how optimistic the sentiment really is, and it's incredibly optimistic right now. If you look at economists, recent survey by Bloomberg showed 55 economists talking about economic growth between third quarter to first quarter '10, and every one of them showed significant positive economic growth over that period. So the optimism, both from an investor standpoint, the AAII numbers, as well as the economic sentiment, is extremely bullish.
So you are confident that we will test and break the lows seen earlier this year at some point?
Yes, I was just on Fox Business Channel yesterday, and Liz Clayman asked me, and I said that I'd never been more confident of anything in my life, that this market was going to break through the old lows. The 666 level that a lot of people, their eyes glaze over when you talk about, actually breaking through that level. I think that's baked in the cake. Our problems are so extreme, and we have not cured any of the problems that got us into this mess of this private debt to income ratio overhang. And in fact, we've made it worse. We just simply transferred a lot of debt to the public sector, and we run the risk of bankrupting the entire system.
David, if you look at the Japanese market on the Nikkei, that market has been hammered for 2 decades, dropping during that time roughly 85% top to bottom. Why do some people and investment professionals think that the United States can get through this with one smash down like we have seen? I mean, isn't the Japanese market telling us something about how long and painful the correction of excesses can be?
It's simply stupefying to me, Eric, that there's not better understanding of economic theory. And the examples are so prevalent, both 1930s as well as the Japanese experience. We're at 40,000 on the Nikkei in 1989. We're 20 years past that. We're still 75% below that level. Japan has pulled out every stop in terms of fiscal and monetary stimulus, and the Japanese actually saved money. However, there's no understanding. Everyone believes in this Keynesian theory that we have this under control, that we need to get the consumer to spend more money again. I think this, lame view is encapsulated well by, a comment that Bob McTeer made back in 2002. And he said, everything will be all right if we all hold hands and buy a new SUV. And when you think about how ridiculous that statement is, but essentially that's Keynesian economics in a nutshell here. We need to get the consumer to go out and spend more money, even though he's already broke and he got into this trouble from too much debt to begin with. I'm a huge believer of the Austrian School of Economics. Tom E. Woods has written a phenomenal book called Meltdown that I'm encouraging everyone to read. He has a website called tomwoods.com that does a phenomenal job of outlining Austrian business cycle theory and essentially the Keynesian theory not working.
There were so many false bottoms in the Nikkei, as you know, David. Why are so many professionals and investors so convinced that our recent lows cannot be broken? Would you just say that it was because of the size of this rally that's happened so far?
Well, I think a lot of it, Eric, is that people just want to believe, and people want to be optimistic. And the other thing, obviously there's vested interest with most portfolio managers being long, and those are the talking heads that come on TV. The media is obviously, their vested interest is to take in more advertising. Their salaries are higher if the market does better. Everyone wants a better future, for their kids, et cetera. We want to believe, and therefore we tend to seize on any positive news. The other thing is we all learn from the recent past. And over the last 20 years, essentially every decline has truly been a buying opportunity. The market has gone up again. The Fed has cut interest rates. We've brought the economy back. We've stimulated consumption. We've got individuals to go back and mortgage up their homes again and spend more money. And therefore, it's made sense to be bullish generally at the bottom when these big declines occur. But what people don't realize is that there's been this massive change now. The investment banks are no longer in business. We've suffered a 20% plus cut in household net worth. This has changed. We've changed the attitudes of individuals from, as David Rosenberg says, from frivolity to frugality. And now this is different. But so people want to believe, and they've seen some economic numbers actually get slightly better in that they're less worse than they were before because of massive stimulus. And as Chris Martenson has said, yes, individuals will spend free money, which is essentially the various incentive packages, the $4,500 cash for clunkers, $8,000 tax credit for first-time home buyers. California can get $10,000 for a new home purchase. Therefore, people are spending that money, and it's made the economy less worse. And therefore, people with this innate optimism want to seize on that and think things are going to be all right.
What about consumer demand, then? Where is the consumer today, David? Because you kind of touched on that a little bit.
Well, we think the consumer is hurting. There's a lot of people out of work. There's a lot more people out of work than that 9.7% stated unemployment. If you look at the U6 unemployment that measures discouraged workers as well as people working part-time that would like to work full-time, I think it's 16.7%. We have a lot of individuals that realize their home declined significantly in value. I like to look at the consumer having three components to his net worth. One is his paycheck and bonus. Two is the stocks that he owns in his IRA and various cash that's invested in the market. And three is home value. In 2008, all three of those legs to his financial stool declined. And therefore, he has suffered a significant diminution in net worth. David Rosenberg, I think, has used a number in the 20% range. There's never been anything like that in the last 70 years or so. And the other thing is, psychologically, the individual is spending less. It's not as cool for him to go out and spend money and talk about a lavish vacation and to drive a brand new car around and beat his chest and act like how cool he is. Now it's more cool to be frugal and to conserve. Now, in the last 3 months, with media attention on spending money and this Bob McTeer theory, everything being all right if we all hold hands and buy a new SUV, I think people have gone out and spent a little bit more money,